Thank you very much. I thank City Book Fair for having me, and I've been looking forward to this. You know, a lot of commentators, if you listen to the commentators, there's a suggestion that everyone that works in a bank or in an investment bank in particular is a millionaire. Well, I'm here to tell you that isn't exactly true. I'm living proof that that isn't exactly true. And I'm not sure whether I should say that I regret that. We have become so politically correct that in some instances wealth is not something which should be celebrated. However, the main reason why I want to talk to you today is that I believe that the investment banking industry, or the banking industry as a whole, is in trouble. And what I'm going to do is lay out why I think it's in trouble, what needs to be done about it, and why I believe that bankers today have not taken the steps that they need to do to change the game, to make a difference, to actually respond to what has happened in the markets. We can look at this in a number of different ways, and the first is the historical context. In the past 30 to 40 years, we have had a whole series of financial crises. Going back to the 70s and 80s, we've had the LDC debt crisis. And that was followed sometime after by the junk bond crisis. Then we had the Japanese asset price inflation and a crisis that followed that. And then sometime in the 1990s or late 90s, about the 2000 mark, we had dot-coms and then we had dot-bombs. And then, of course, quite recently, we had the subprime mortgage crisis. Each time we've had these crises, it's interesting to note the behaviors that occurred. Market was there, a number of banks saw an opportunity, and they all went chasing after it. In the LDC debt crisis, we had a situation where the global wealth was being reallocated between those oil-producing countries and the rest of the world. They were pumping a lot of oil, they were making a lot of money, and so for some reason the banks realized, oh, if we're going to take all this money as deposits, we have to find somewhere to put it. And they put it in LDC countries. And at the time, Walter Wriston, then CEO of Citibank, said, well, countries can't go bust. But of course, countries did go bust, and we had the LDC debt crisis. Then we had the junk bond crisis, and I think Modigliani and Miller were all the rage at that time. Debt doesn't matter. You can saddle up an organization and a company with as much debt as you want. That's irrelevant as long as we have the cash flows to match. Well, guess what? The cash flows didn't match up. And once again, a whole number of banks got caught into the game, lemming-like behavior, and they all fell down the tubes. Similarly, in Japan, where we had a major attempt to restructure the Japanese economy. Because what was happening was that Westerners were complaining that there was just too many Japanese imports, and that the West was at a disadvantage. And they said, Japan, you go and reflate your economy. And I remember at the time, if you went anywhere, everyone said, Japan is going to rule the world. Learn Japanese. Learn to bow at the right angle. And of course, a lot of money went into debt and equity and property, and that market fell down. Come to in the late 1990s or 2000s, we were told that the internet was going to change everything. It was going to change everything so much that you did not need any form of a business plan to get started. All you needed to do was set up a website, and you were away. You'd be Microsoft or Apple the very next day. And of course, that fell down. But once again, banks rushed in and all got into trouble, and a lot of investors lost a lot of money as well. A subprime crisis was no different from what's been happening over the past 30, 40 years. We have a situation where we had a subprime mortgage market that was growing slowly along, somewhere about 6 or 7% of the total mortgage market. And all of a sudden, someone thought it was a good idea to really hype up this market, and it jumped to 20% of originations. Everyone piled in, the whole thing fell down, and we have all had to live with the aftermath of that. What's been amazing to me in all of this is that the CEOs and senior executives of banks would have been, say, around the 50-ish mark, and they would have seen and experienced all of these events sometime during their life. They would have grown up, they probably would have been at college when the LDC debt crisis was taking hold. And throughout the professional career, they would have seen all of them. But still, why is it that in every single case, even with this knowledge, they still allowed their banks in 2008 to go down the tubes? And I've grappled with this question. And to me, the first thing that banks have to do, the very first thing that banks have to do is to be able to think independently. Because if you look at all of these crises, what happened was, a new paradigm was created. In terms of the subprime mortgage crisis, for example, it wasn't just banks. It was central banks. Governments were talking about Goldilocks economy. You had, I remember, I think it was the London Business School, one of the premier institutions in the world, honored Fred the Shred, right? He got knighted by the Queen. Economists, commentators, everyone was saying how fantastic this was. This was supposed to be, it was the end of inflation. And what happened? The whole thing fell down. And when the whole thing fell down, everyone turned around and looked at the banks and says, it's your fault. You're responsible. So banks have to develop a capability to think and act independently. They have to break out of what I call this fiendish orthodoxy, where every time there is a crisis, a rationale develops over why the markets behave they do and why they're correct until it comes tumbling down again. And the fact that it has happened so many times within the past 40 years tells you or tells us that banks have simply been unable each time to break out of this fiendish orthodoxy that exists at that particular point in time. And we can only wonder what will happen next. So that's the first thing banks have to do. Develop an independent methodology for looking at their business. I actually think what they need to do is literally develop a very senior and parallel management structure, which is actually divorced from the business, and one which says, you know what, we're taking an alternative look at what you do, because nothing else has actually worked so far. Now, moving on, if we look at the current context, there's something which I find very, very amazing, because we have two different groups living in their own parallel universe. On the one hand, you have commentators, some politicians, a lot of journalists, and when you listen to them, the word you hear is that, casino banking, casino banking, casino banking. Some of them have what I call derivative derangement syndrome, or DDS, because the whole problem in the banking world is because of derivatives and nothing more. Which I think they should ask Bank of America about Countrywide, or they should ask themselves about Northern Rock or Bradford and Bingley. But it's just an example of the non-thinking which exists. But the problem with many of these non-thinkers is that they are the ones who are setting the agenda for the future of the banking industry. They are the ones who are informing people out there that banks are all bad, everything is casino banking, it's all evil, it's bound to fail. I mean, it's so bad. I remember sitting on my sofa one evening watching a major newscast, or a major news organization, and the city reporter, so you assume that this person knows a bit about banking, actually said that the separation between investment banking and retail banking is about separating customer business from non-customer business. So in other words, what this person was actually trying to say was that investment banks don't have customers. Now, just in case they're listening, investment banks do have customers. They take corporate customers who are looking for capital, and pension funds and insurance companies who are looking, and other institutions are looking to invest, and they bring them together. That's what investment banks do, but they also help to structure and manage their risks. I'm not saying that they're without fault, because that's why we're here. That's why we're having this discussion right now. But that's essentially what investment banks do. But that's one side of the argument. The other side of the argument is that it appears to me that bankers have not fully recognized the extent of the damage that has been done. They have not fully recognized that they actually need to repair what has happened in the past. They need to repair the relationship between them, their customers, the community, and even their employees. Now, it's the reason why I wrote Clearing the Bull was actually to look at these two sets of people in their own parallel universe and say, you know, this doesn't work. Neither of you are correct. You know, neither of you can take the industry where it's supposed to be. You know, bankers, it appears, believe that if we just cut down some more risk, if we, you know, cut back on some activities, and if we say nice things to people, then things will change. And on the other hand, others believe that if we simply demonize the banks, then we will get the change we want. I think neither of them have a strategy to move the industry forward. And what's amazing to me, actually, is that we haven't had a banker who has stood up and say, this is how we are going to change how we relate to the rest of the world. This is how we're going to change our industry. This is how we're going to change what we do and how we do it and how it affects other people. And that I find amazing. And we have no Henry Ford. We have no A.G. Toyoda. If any of you ever learned this, the story of A.G. Toyoda, he went, after Japan was destroyed by the arsenal of democracy, which is America during the Second World War, he went off to Detroit to see this arsenal of democracy at work. He looked at it, he came back, and he said, it's a waste. Can you imagine, after your country has been flattened by America, you look at their production model and say, it sucks, it doesn't work for us. But that's the kind of thinking that we probably need in banking right now. We need someone to say what we've done in the past, what's been happening over the past 40 years, the disasters, the recent disasters that happened don't work. The little tinkling that we do around the edges won't take us into the future. And that's what Clearing the Bull is all about.